Well, hello traders and investors. Today is December 2nd. Where is the year going, right? You might have noticed I'm not in my usual location. I usually do these videos in my home office and then I head into the actual studio. But this is actually a new studio that we're going to be debuting inside our offices. And I decided to come here, not because I wanted to, but because I had to. The generator in our subdivision exploded, literally caught on fire, and there's no electricity. So I came here a little bit earlier than I usually do to do this video, but at the same time, it gives you a chance to see our new office, and you'll be seeing me doing a lot of videos from here. So I'm really excited to present this. I was just hoping to do it in a different way. If you like this background, if you like my office, I've got a nice fireplace behind me. It actually works. This is all real. Let me know. Give me some feedback. So let's get into global economy, and let's start with the world. So global shares and Wall Street futures slipped Wednesday as buying enthusiasm waned after NASDAQ and the S&P made a record high. Imagine that. Benchmarks in Paris, London, and all over the world climbed, but investors are betting that COVID-19 vaccines may bring on a fuller global economy. Folks, I'm telling you, it's like one of those James Bond movies where you've got the bad guy with his fingers on the missiles, and then you've got James Bond trying to figure out how to solve it. It's literally that type of a scenario. Would the vaccine come out first, or will the COVID-19 completely devastate the world how it did actually not last year, but beginning of this year? It's amazing that this is happening all over again, and we're literally talking about the same thing that we were talking about less than a year ago. Renewed talks of possible U.S. stimulus package failed to drive major gains in most world markets, which is not unexpected. I mean, unemployment rates are at sky high. Even China is closing things up again. Rebound in third quarter GDP reversed around 40% of the decline during the first half of the year, and we expect output to return to pre-virus levels by mid-2021. I think it's going to be a little bit beyond that. I think it's going to be more like summer of 2021. Well, actually, if you think about it, summer is middle of 2021, so they may be right. I'm thinking next summer. Next summer is when things are going to get better. So we're going to miss the fall and the spring, and that's 2 quarters of the economy. News that former Federal Chairman Janet Yellen accepted President-elect Joe Biden's nomination to be Treasury Secretary lifted sentiment. She's very conservative. She's very precise. She doesn't go back and forth, and she keeps her opinions close to the vest. I can't say enough good things about Yellen. I think she'll do a good job. She may not be the best candidate, but she's a really, really good candidate under the current scenario. And OPEC, they continued their talks yesterday about how much pumped next year as countries wrestled over whether to extend the production cuts. Members put off from Tuesday to Thursday a meeting with non-OPEC oil producers like Russia, who have been coordinating their actions with cartel. And crude oil prices right now are at $44.41 a barrel, a little bit above and beyond the price that U.S. frackers pay for a barrel of crude so they can start working with it. Overall, here are the technicals. I'm not going to take forever today. I want to be brief to the point, and I want to make sure you guys have the plan. Now, this is the S&P 500. I talked about this yesterday, and I'm talking about this again today. This is momentum levels. We're making higher highs. Momentum is drastically making lower highs. All right? Very, very, very simple. If you look at the QQQ, you will see very similar price action. Let me bring this down to a daily chart basis so you could see what I'm talking about. There was no divergence, but yesterday we made all-time highs. And again, momentum levels are overbought, but they can't reach the levels we saw in September and October and November. So momentum levels are telling us that the market's really overbought. Price actions telling us markets are overbought. And we're seeing divergence between the RSI oscillator and price action, which is a huge, huge, huge indicator that something is not kosher and that something has to give. And again, we're seeing this in the S&P and we're seeing it in the NASDAQ. Now, also take a look at momentum levels. So technically, what I was showing you right now was divergence. This is technically. Now, this is sentiment. Now, if you look at the market, see, when you're looking at the market from a technical perspective, the market capitalization of each stock can play a vital role in how much the index goes up or down. But when you're looking at the market internally, and this is the number of stocks trading above the 200-day moving average, you're looking at all the stocks in the S&P or the NASDAQ from an equal perspective. And I need to show you this. This is a 5-year chart on a weekly basis. Look at momentum levels. We're at the highest level in 5 years. Highest level in 5 years. We're in nosebleed levels here, folks. And if you look at a max, which is about 20 years, you could see we've only been to at these levels a few times, literally once, twice. And this is 20 years, actually like 13 years, doesn't go back further. But this is like a decade ago. So you're looking at over a decade, and this is where we're at right now. So you've got to be very, 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 very careful. And also, it's not just that way of the 200-day. If you look at the 50-day line on the S&P, you will see here it's 91% of stocks, so it's like 450 stocks. Here it's like 85% of 500 is what, about 420? Look at that. We're at these levels, folks. And again, on a 50-day basis, short-term basis, we've got 84 or 85% of stocks. That's over 400 stocks in the S&P 500 trading above the 200-day moving average. If you look at the NASDAQ, momentum levels on the NASDAQ, you will see the story is very, very similar. And again, I've been talking about this quite a bit, but the reason I'm talking about it quite a bit is because when this happens, the market tends to have a cool-off. And you could see here, 81% of stocks. This is only 100 stocks. This is the top 100 NASDAQ stocks. You've got to see this with yourself, with your own eyes, I mean. That's the bounce after the cool-off, the meltdown that we had in February, March, and April. That's the reaction. We went down all the way, and now we're above 81%. So you've got 82, 83 stocks out of 100 trading above the 50-day moving average. And when you look at it on a longer term, you've got 88 stocks out of 100 trading above the 200-day moving average. Look at where we're at right now. Notice, again, highest level. This is max. This is like going back to 2010. Look at this thing. Look, do you see that? Just here and here. And anytime we go above that level, the market sells off. Now, with that said, I am still seeing a particular sector doing really, really well, and actually stocks. The one thing I'm going to tell you that's good about this rally, it's broader. It's a lot broader than the rally that we saw in February or in March of last year or April of last year. Much more stable. So, for example, let me show you what I'm talking about. This rally here, was not very broad. It was very narrow. It was narrow towards tech, stay-at-home stocks, COVID stocks, Peloton, Zoom, so forth. But this rally here has been very, very broad. But even with that said, and here you could see the rally, this is the NASDAQ 100. You've got Expedia. You've got travel stocks. You've got Marriott on here. But here's the sector that I want to tell you that's really heating up right now, the semiconductors. Look at this. LRCX, Qualcomm, Applied Materials, Xilinx, Micron, NXP, Microchip, KLA, Maxim, Advanced Micro. This is like the top 20 stocks in the NASDAQ 100. Most of them, or at least half of them, as I just named, are semiconductors. So if you look at SMH, which is the semiconductor ETF, you will notice that it's doing really, really well, but it's not diverging. See, it's overbought, but it's not diverging. You see higher highs here, right? Higher highs, but momentum levels are showing the same thing. We're not really backing off of the momentum. So that's a huge, huge difference between this index, the SMH, and the Dow, and the S&P, and the NASDAQ 100. NASDAQ 100 and the S&P are showing divergence. This is just showing overbought level, which means it'll probably cool off, but there's a lot more upside left. And the fact that semiconductors are aggregating near the top of the NASDAQ 100 is a very, very good, strong point. It's telling us the market's going to go higher, but it needs to cool off. So this divergence is telling me markets are more vulnerable than ever, but it's telling me that after a minor cool-off period, semiconductors should continue to lead. And if you want to look at the index of semiconductors, it's $. Here, let me show you. $SOX. That's the index. And you could look at, if you want, you can actually, that's the index. But if you look at SMH, that's a tradable ETF. And they really mimic each other, as you could see here. And you could also look at the constituents so you could see what's in it if in case you want to trade the stocks individually. But I promise you the top stocks here are all the top stocks that are making headways in the NASDAQ 100 as we speak. So markets are vulnerable. The strongest sector, semiconductors. Now, before you go, the next gold rally, folks, it's in full swing, with profits flowing to those who play their cards right. Unfortunately, most people don't understand how to make quick returns off these slow-moving gold trends. And folks, if the market cools off right now, as I'm expecting, remember what I just said, the market's vulnerable, divergence, gold is going to go higher. It's just a matter of how much. So they sit in, buy and hold gold strategies. They take years to play out. That's not the way to do it. While in the no traders, they collect gains week after week because they time gold. Don't let that be you. Don't be the guy that sits in gold for years and years waiting for a payout. Instead, learn how to take advantage of commodity rallies like gold while they're still in their early innings. You can get started by clicking the link below, watching the short presentation. And I'm going to tell you something, folks. Vulnerability in stocks, let me show you this. When stocks go down, I want to show you something eye-opening. This is SPY. And look at the gold market. And I want you guys to see this. Gold's been going negative while stocks have been going positive. As soon as we start cooling off, and I'm telling you right now, this divergence and 91% of stocks above the 200-day moving average, the market is screaming sell-off coming. Maybe not a big sell-off, maybe a small sell-off. What's one of the best ways to hedge yourself? Gold. And guess what? It just traded below the 200-day moving average. It's now trading above the 200-day moving average, and it looks like it's going to go back up. I hate to say I told you so, but that usually is the case. You got to check out this gold strategy. It'll teach you how to be in the gold market only in the right time. Take advantage of it. Do it now. And most importantly, have a great day and give me some feedback and let me know if you like my new office. Bye.